Happy Friday, IHMC friends and family. It is Shayan with Integrity Home Mortgage back with your weekly mortgage market commentary. There's a risk-on tone dominating this week as investors felt comfortable letting go of some of their worst-case scenario fears. And why is that? Well, despite a rocky start, the ceasefire between Iran and Israel is holding. Fed Chair Powell delivered testimony before Congress this week, which struck a slightly more dovish tone than his press conference did last week. Dovish meaning that he seems a little bit more inclined to cut rates in the near future. We got a weak GDP number. The official final read on GDP for the first quarter came in at negative 0.5%, meaning that the economy actually shrank a bit in Q1 versus Q4 2024. And while core PCE, which is the Fed's favorite measure of consumer level inflation, came in slightly above forecasts, it wasn't enough for markets to buck the trend because it was accompanied by drops in both personal spending and personal income. So together, all this has pushed interest rates to their best levels since April, early April, really. And today we're seeing a little bit of a pullback, but that has less to do with bonds directly and more to do with some excitement around equities, with the S&P and NASDAQ both flirting with all-time highs. Next week is an important one, but it could be a little bit of a wild ride because of the July 4th holiday late in the week. Wall Street traders, after all, take vacations just like the rest of us. I guess just a little fancier. So look for increased volatility as if there are some surprises in the numbers. It's tough to predict these days where the next big headline will come from, but jobs are going to be the big news in economic data. Remember, the Fed's mission is to control inflation and maximize employment. Recent inflation data has been pretty benign, so these employment numbers are really highly anticipated. If we see a steady or weaker jobs picture coupled with Powell's recent dovish comments and the benign inflation, that should be good news for interest rates. But there are some risks. We're about a week and a half away from the deadline for increased tariffs on the EU and several other countries. Both sides report negotiations are ongoing, but comments from the administration today were hinting at the idea that they may extend those deadlines, and the rumor is maybe until Labor Day. The deadline for the Senate to get their version of the big, beautiful bill to the president's desk is July 4th. President Trump today said that the date is important, but isn't like the end all. So I guess that could be delayed too. This has become a fairly familiar theme. My bottom line this week is that it is a good time to lock. The recovery we have had has been significant, and we are spitting distance from the best rates we've had in the last 6 months. The market is pricing in 2 cuts over the remaining 3 Fed meetings in 2025, and it'll take significant economic weakness to motivate them to go 3 for 3, which is an unlikely scenario. Additional good news for interest rates may improve mortgage rates a little bit, but I think it's more the case that it's what's going to power us, enable us to hold on to the improvements that we've already received. Meanwhile, trade relations, geopolitics, and just the general PTSD that markets have gotten over the past 3 years is going to keep things jittery and could turn markets the other way pretty abruptly. So it's feeling like a good time to take some chips off the table and lock loans if you have them. That's all I got for this week. I hope you guys have a great weekend, and we'll see you next week.